In the heart of New York City, on a cool Monday morning in October 1987, something unthinkable was about to happen. Wall Street, the beating heart of American capitalism, was about to stop breathing. The sun had barely risen over Manhattan when the trading floors started buzzing. It was supposed to be just another day, but by noon, the calm had turned into chaos. Phones rang endlessly, screens flashed red, brokers shouted, their voices cracking through panic. And as the clock ticked closer to the market's close, the unimaginable unfolded. The Dow Jones Industrial Average crashed by more than 22% in a single day. They called it Black Monday. It remains, even now, the largest one-day percentage drop in U.S. stock market history. That day, nearly $500 billion vanished into thin air. People stood in disbelief as the once invincible Wall Street fell silent. Traders who had been making millions just days before were suddenly ruined. And across America, ordinary investors, teachers, engineers, small business owners stared at their televisions, watching their savings disappear. It was more than a market crash. It was a national shockwave. But the story didn't start that morning. The seeds of disaster were planted months earlier. The 1980s were an era of confidence, maybe too much confidence. Ronald Reagan was in the White House. The economy was booming. The American dream felt alive and invincible. Wall Street had become the center of ambition, greed, and innovation. The streets of Lower Manhattan pulsed with optimism. Everyone wanted a piece of the action. But behind the excitement, something darker was brewing. Interest rates had been climbing, the dollar was unstable, trade deficits were widening, and global markets had become more interconnected than ever. But the biggest shift came from technology, a new form of trading powered by computers. They called it program trading. It was designed to make markets safer, to automate decisions when volatility hit. But in reality, it became a ticking bomb. These machines were programmed to sell when prices fell, to limit losses. But when thousands of systems across the country started selling simultaneously, it created a cascade. Prices plummeted faster than humans could react. By the time traders tried to intervene, the system was already in free fall. At the Chicago Mercantile Exchange, where futures contracts were traded, chaos erupted. Some brokers stopped answering phones. Others screamed across the pit, desperate to find buyers. But there were none. The market was drowning in its own fear. On the New York Stock Exchange, specialists who were supposed to keep the market orderly simply couldn't. The volume was too high. Orders stacked up faster than they could be processed. Some stocks went hours without trading. Others fell so fast that their prices couldn't even be updated in time. It was as if the entire financial machine of America had jammed. For many Americans, it was déjà vu, the ghost of 1929 returning. Old black and white photos of men standing outside the New York Stock Exchange, faces pale, pockets empty, suddenly felt real again. Television anchors spoke with trembling voices. Headlines warned of economic collapse. But the real story was deeper. Black Monday wasn't just about panic. It was about how technology, greed, and human psychology collided. The markets had become a mirror reflecting human behavior, the fear of loss, the rush of greed, the illusion of control. And just like in 1987, those same forces are stirring again today. Fast forward to 2025, the tools have changed, but the game hasn't. The trading floors are quieter now, replaced by algorithms, bots, and AI systems that can execute millions of trades in milliseconds. Retail traders sit behind screens armed with apps like Robinhood or Webull, thinking they have power. But behind the scenes, massive funds and institutions are running complex models that can move billions in seconds. In 1987, the danger came from computer programs selling at once. In 2025, it comes from artificial intelligence predicting market sentiment before humans even react. When everyone uses the same data, same models, and same signals, what happens when the machines panic again? The markets today are built on the same fragile foundation, confidence.
The Federal Reserve's decisions ripple through every stock, every bond, every crypto chart. One comment from Jerome Powell can wipe out trillions. Inflation fears, interest rate hikes, debt ceilings, they all echo through the same system that once collapsed in 1987. And yet, investors are doing what they always do, ignoring the warning signs. They're buying dips, chasing hype, celebrating bull runs that look unstoppable. Just like the traders of the 80s, they believe the system can't break again. But history whispers otherwise. Back in 1987, the signals were there. The market had soared more than 40% in less than a year. Price-to-earnings ratios were stretched beyond reason. Everyone believed the rally would never end. It always feels that way, right before it does. In the weeks leading up to Black Monday, global tensions were rising. The US was battling trade disputes with Japan and Germany, oil prices were unstable, treasury yields were rising. Yet the optimism kept building until the dam broke. And when it did, it happened faster than anyone could imagine. Some traders compared it to watching an airplane crash in slow motion. They knew it was happening, but there was nothing they could do to stop it. The automated selling triggered more selling. Portfolio insurance strategies meant to reduce risk ended up multiplying it. Within hours, the world's most powerful economy looked fragile. The crash spread across the globe. London, Tokyo, Hong Kong all followed. It wasn't just an American crisis. It was the first truly global financial panic of the modern age. Yet what followed was perhaps even more surprising. The US didn't fall apart. The markets recovered faster than expected. Within 2 years, the Dow was back near its previous highs. America proved something that day: resilience. But it also forgot something: that markets crash not because of numbers, but because of people. Every bull market plants the seed of its own destruction. Every period of euphoria ends the same way, with fear. And in 2025, that cycle may be repeating once again. The signs are everywhere. AI stocks soaring to unbelievable valuations, retail traders flooding back into risky options, crypto markets reviving after years of dormancy. The same feeling of "this time is different" spreading through the internet. But it's never different. It's always the same story, only the players change. The difference today is speed. In 1987, it took hours for panic to spread. In 2025, it can happen in seconds. One tweet, one rumor, one unexpected data point, and the algorithms react instantly. Billions can vanish before the average trader even knows what happened. That's the danger of progress. The tools that make us powerful also make us vulnerable. When the first computerized trading systems crashed the market, no one understood how interconnected everything had become. Today, with AI, machine learning, and 24/7 markets, that web is even tighter. One glitch, one miscalculation, one mass reaction, and history could repeat itself faster and harder than before. So as the market soars towards new highs and headlines celebrate the unstoppable American economy, one question lingers quietly in the background. Have we learned from 1987, or are we just repeating it with faster machines? The ghosts of Black Monday haven't disappeared. They've simply evolved, waiting for the next panic, the next moment when confidence turns into chaos.
In 2025, Wall Street looks nothing like it did in 1987. The shouts are gone, the paper slips are gone. The chaos has moved from the trading floor to the cloud. The new traders aren't wearing suits. They're sitting in hoodies behind screens, armed with algorithms, artificial intelligence, and real-time data feeds that never sleep. The hum of machines has replaced the roar of men, but the heartbeat of the market, greed, and fear hasn't changed. It's only been rewritten in code. Across the US, millions of retail investors trade from their phones, watching green and red candles flicker like pulse lines on a heart monitor. Every dip, every spike, every rumor spreads in seconds through Twitter, Reddit, and Discord. The new Wall Street is digital, decentralized, and dangerously emotional. But the deeper truth is this: technology may have changed the tools,
but it hasn't changed human nature. Just like in 1987, the system runs on belief that prices will always rise, that someone else will buy higher, that the next innovation will save us. But behind the digital noise, a storm is building. AI trading systems now control more than 70% of all US market volume. These aren't just programs reacting to prices, they're predicting behavior, analyzing headlines, scanning emotions from news articles and social media. They can sense fear before humans even feel it. And that's what makes them both powerful and terrifying. Because when fear hits, these machines don't hesitate. They sell instantly. They follow the code. And if one major algorithm triggers a sell-off, the rest follow. Just like in 1987, only 1,000 times faster. Imagine this. It's a Tuesday morning in 2025. The S&P 500 opens slightly lower after a weak inflation report. A few hedge fund models start trimming positions. Then an AI system misinterprets a Federal Reserve comment, assuming rates will rise again. Within seconds, billions of dollars in automated trades flood the market. Prices tumble. Stop losses activate. More algorithms join in. Within minutes, the system feeds on itself, a digital echo of 1987's chaos. But this time, there's no trading halt fast enough. No human hand to stop the chain reaction. The market isn't crashing on paper, it's collapsing in data. Some experts call this scenario Flash Crash 2.0. Others believe it's inevitable, because history doesn't repeat itself by accident. It repeats because we keep believing we're smarter than the past. In 1987, investors trusted computers to protect them. In 2025, they trust AI to make them rich. The illusion is the same. And the warning signs? They're everywhere. Stock valuations at all-time highs, corporate debt at record levels, retail speculation back in full force, meme stocks reawakening from the dead, crypto coins rallying overnight on nothing but hope, tech CEOs promising AI will change everything. Again. It's the same playbook with new characters. The dot-com dreamers of 2000 are now the AI evangelists of 2025. Back then, it was the internet. Today, it's artificial intelligence. And every bubble feels real until it bursts. The irony is that AI might actually trigger its own collapse. These systems feed on the same data, the same news, the same trends, the same human reactions. When everyone trains their models on identical information, they all end up making the same decisions. It's like millions of brains thinking the same thought at once. And when that thought is sell, chaos begins. And it's not just stocks. Crypto markets, once seen as the alternative, now move in sync with Wall Street. Bitcoin rallies when tech stocks rise and crashes when they fall. The dream of financial independence has merged back into the same machine it was meant to escape. The Federal Reserve stands at the center of the storm once again. Every word from Jerome Powell moves markets in seconds. A single sentence about inflation or rate cuts can erase hundreds of billions in value. In 1987, it was interest rates and the dollar. In 2025, it's the same, only faster, louder, and global. Meanwhile, ordinary Americans are once again being drawn into the fire. Influencers promise easy money. YouTubers show charts with guaranteed profits. Apps make it look like a game. But the market is not a game, and it never was. It's a machine that rewards patience and punishes emotion. And yet emotion is what drives everything now. The same optimism that filled Wall Street bars in the 1980s is now flooding online chat rooms. Everyone wants the next big thing, the next Nvidia, the next Bitcoin, the next overnight millionaire story. But no one talks about what happens when the music stops. Because it always stops. The last time America saw a wave of this size, it was before the dot-com crash, before the housing bubble, before 2008. Every generation thinks they've found a smarter way to play the same dangerous game. And every generation learns, painfully, that markets are powered not by innovation, but by trust. When that trust breaks, the crash begins. Picture the scene again, but this time not in 1987. It's 2025. The US stock market is at record highs. AI-driven trading funds are the new kings. Retail traders are all in. And then, one morning, the screens flicker. News breaks about a sudden policy shift, or a global cyber attack, or maybe an AI glitch. Panic spreads through algorithms like electricity. Prices plunge, crypto collapses, major exchanges pause trading. Social media explodes with fear. Hashtags trend. People refresh their portfolios in disbelief. And just like in 1987, it all happens too fast for anyone to stop. Within hours, the Federal Reserve steps in, promising stability. The president addresses the nation, assuring Americans that the fundamentals are strong. The same words they used decades ago. But behind the calm tone, the truth is clear. The system has reached its breaking point again. Because technology can't fix human emotion, it can only amplify it. The 1987 crash wasn't just a financial event, it was a psychological one. It exposed how fragile confidence really is, and that's still true in 2025. No matter how advanced our trading systems become, no algorithm can erase greed, fear, or the illusion of control. The lesson of 1987 isn't just about markets. It's about humility. It's about understanding that progress without restraint leads to repetition. Every new generation of traders believes they've outsmarted history until history reminds them who's in charge. And when the next crash comes, it won't be called Black Monday. It might be a Friday afternoon or a random Tuesday morning, but it will carry the same silence, the same disbelief, the same helplessness that filled Wall Street in 1987. People will say it was unpredictable. They'll say no one saw it coming. But the truth is, it's always visible to those who listen to history. The signs were there then. They're here now. The only question left is whether America's willing to hear them this time. Because history doesn't whisper forever. Eventually, it screams. And when it does, the echoes of 1987 will once again roll through Wall Street, not as a memory, but as a mirror showing us what happens when progress forgets its past and confidence turns into chaos.